Most LPs think of a real estate syndication as a partnership between them and the GP, a single entity they're trusting to execute the deal. But in many syndications, especially larger ones, that GP is actually two separate functions performed by two different parties, a deal sponsor and an operating partner. Understanding which is which, what each is responsible for, and how to evaluate both is essential to knowing what you're actually investing in. In this video I'm going to break down the deal sponsor and operating partner roles, explain how to identify when they're separate, and give you the specific questions to evaluate each one independently. Let me start with the definitions. The deal sponsor, sometimes called the capital raiser, the syndicator, or the general partner of record, is the entity that originates the deal, structures the offering, raises LP capital, and is legally responsible to investors. The operating partner, sometimes called the operating GP, the co-GP, or the local operator, is the entity with on-the-ground expertise in the market. They may source the deal, manage the property, oversee renovation, and execute the business plan. In some syndications, the same entity performs both functions. The GP sources the deal, raises the capital, and runs the asset. One team, fully integrated. In other syndications, increasingly common as the industry has grown, these are two distinct entities with a profit split between them. The sponsor raises capital from a national investor network. The operator has local market expertise and execution capability. They divide the GP economics. When they're the same entity, your due diligence is straightforward, you're evaluating one team for both capabilities. When they're different entities, your due diligence doubles. You're evaluating two teams, their combined track record, and the strength of their relationship. And the fees, the promote, and the governance may flow differently through the structure. How do you know which situation you're in? Ask. Are you the deal sponsor and the operating partner, or do you work with a separate operating partner? Read the PPM. The risk factors section will typically disclose if the GP relies on a third-party operator. The management section should identify both entities. Review the waterfall. If the GP side of the promote is shared between two entities, sponsor, 15%, operating partner, 15%, you're in a co-GP structure. Let me walk through how to evaluate the deal sponsor. The sponsor is who you have a legal relationship with. They signed the operating agreement. They raised your capital. They are accountable to you. Questions to evaluate the sponsor. How many deals have they syndicated? What is their track record of realized returns across their full portfolio, not just selected highlights? What is their investor communication record? You want to talk to LPs from past deals, specifically during difficult periods. Did the sponsor communicate proactively when things went wrong? Do they co-invest in their own deals? Skin in the game matters. A sponsor who invests alongside LPs has financial alignment. One who earns only fees without co-investing has weaker alignment. How long have they worked with this operating partner? A first-time relationship between sponsor and operator introduces execution risk that a long-term partnership doesn't. What happens if the operating partner underperforms or fails? What are the removal mechanisms, and who has authority to execute them? The sponsor's ability to protect LPs if the operator fails matters. The sponsor's job at its core is, find good deals, raise good capital, partner with good operators, and manage investor relationships with integrity. All of those are evaluable. What they're not is, the people on the ground running the asset. That's the operating partner. And their capability matters just as much. Here's how to evaluate the operating partner. The operator is the team executing the business plan. If the deal is a value-add multifamily repositioning, the operator is overseeing the renovation, managing the property manager, hitting the lease-up schedule, and optimizing revenue. The projections in your deal summary depend on them. Questions to evaluate the operator. How many assets do they currently manage in this market? Local knowledge and relationships matter. A deep-rooted operator in Dallas knows submarket dynamics, contractor availability, and permit timelines that a generalist doesn't. What is their track record on comparable deals, same asset class, same value-add strategy, same market? A sponsor may have a strong multi-market track record. The operator's track record in this specific market and strategy is the more relevant predictor. Have they worked with this sponsor before? If yes, ask how those deals have performed. If no, understand what due diligence the sponsor did before selecting them. How do they handle renovation? In-house general contractor, or third party? If third party, what's their vetting and oversight process? Cost overruns and timeline delays are the most common cause of missed projections on value-add deals. What is their property management capability? Some operators self-manage. Others use third-party property management. If third-party, who? That firm's performance in this market matters. Now let me address the fee and promote allocation in a co-GP structure. When a deal has both a sponsor and an operating partner sharing the GP side, the economics are split between them. How they're split matters to you because it tells you about incentive alignment on both sides. Common structures. Equal split, sponsor and operator each receive half of the GP's promote. Works well when both contribute equally to value creation. Performance-weighted split, operator receives a larger share of the promote, say 60%, because they're the ones executing. Sponsor receives 40% for capital raising and investor relations. This is often more appropriate when the operator has deep expertise. Fee allocation, acquisition fees may go to the sponsor, compensating for capital raise. Asset management fees and property management fees may go to the operator. The total fee picture should be understood as a combined GP expense. Ask, how is the GP promote split between the sponsor and operator? How are fees allocated? This tells you where the financial incentives sit. The risk specific to co-GP structures that you should ask about. Conflict between sponsor and operator. What happens if they disagree on a material decision, sale versus hold, renovation scope, financing strategy? Who has final authority? The operating agreement should specify decision rights clearly. Operator replacement. If the operator underperforms, what is the sponsor's authority to replace them? Can they do it unilaterally or does it require LP consent? A sponsor with no removal authority over a failing operator leaves LPs exposed. Sponsor replacement. Less common but worth asking, what governance rights do LPs have if the sponsor fails in their obligations? Continuity risk. If the operator is a small firm built around one or two key people, what happens if one of them leaves? Key person provisions and succession plans matter more in small operating firms than large ones. Here are the questions to ask when evaluating any co-GP structure. 1. Who are the two entities, sponsor and operator, and what is each one's specific responsibility? 2. How long have they worked together? How have those deals performed? 3. What is each party's track record independently, and what is their combined track record? 4. How is the GP promote split between them? 5. What are the decision rights, who has authority on material decisions like refinance, renovation scope, or sale timing? 6. What is the removal mechanism for the operator if they underperform? 7. Does either party co-invest in this deal? These questions apply whether you're dealing with a single integrated GP or a co-GP structure. The single-entity GP just has simpler answers. Here's the summary. Real estate syndications may have one GP entity performing both the sponsor and operating partner roles, or two separate entities splitting those functions. When they're separate, evaluate both. The sponsor is accountable to you legally. The operator executes the business plan. Both matter to your return. Sponsor evaluation, track record, LP communication record, co-investment, relationship history with this operator, and removal authority if the operator fails. Operator evaluation, local market track record, deal complexity match, renovation capability, property management capability, and key person risk. In a co-GP structure, understand how the promote and fees are split, what the decision rights are, and what the removal mechanics look like. The LP due diligence checklist has a full sponsor and operator evaluation section, linked in the description. Subscribe for the next one. We're going to talk about what happens when things go wrong, default, foreclosure, and LP rights when a deal is in distress. Thanks.